On November 5th, 2021, Nike hit the top, but what followed was the pain that persists to this day. In this video, we'll break down Nike's business, uncover key takeaways from its financial performance over the years, and reveal the sweet spot for buying the stock. Nike's business is centered around three key segments, with footwear leading the way as the largest contributor, generating $33.4 billion in revenue in 2024. Apparel follows with $13.8 billion and equipment adds $2.1 billion. There is also a fourth segment, global brand divisions, but has a smaller impact and won't be discussed here. In recent years, Nike's numbers have mostly been on the rise, except for a slight year-over-year decline in apparel. So why has the stock dropped so significantly since its peak in 2021? Could it be due to flat earnings? Let's examine the quarterly results for a clearer picture. Looking at percentage changes compared to the same quarter in the previous year, we see a sharp decline of over 10% in footwear and apparel revenue for Q1 of 2025 and a 10% decline in footwear in Q2 of 2025. While equipment has shown a solid growth in recent years, its revenue remains too small to offset the losses in the two largest segments. The company has also indicated that the recovery isn't likely in the near term. Therefore, analysts are forecasting a 10% decline in revenue for fiscal year 2025, with more turbulence expected ahead. For 2025, total revenue is projected at $46 billion. That said, Nike is still Nike, and turbulent times could present an opportunity to buy the stock while it's undervalued. But what is a reasonable price to pay? To answer that, we need to take a look ahead and consider where Nike could be in 5 years. Keep in mind, what follows is based on assumption and may differ from your perspective. This is not financial advice. Always do your own research before making any investment decision. What can we expect from Nike's performance in the near future? We have already established that analysts expect 10% revenue decline for 2025. But what about 2026 and beyond? Analysts project $47.7 billion in revenue for 2026 and $50.5 billion for 2027. This suggests a sharp drop in 2025 followed by a low to mid-single-digit growth in subsequent years. Before moving on, here's some food for thought. Nike's management has cautioned about challenging times ahead, with competition being stronger than ever. Concerns in the media often arise when a stock underperforms. Therefore, any future misses or negative news from management could amplify downward pressure on the stock. That said, Nike's brand remains a pillar of strength. The Nike brand is currently valued at approximately $30 billion, which accounts for around 30% of the company's market cap of $106 billion. What this means is that if the same numbers were achieved by a less iconic brand, its valuation might be roughly 30% lower. This brand equity can offer a glimmer of hope. If the Nike brand continues to hold its value, it could help absorb some of the near-term pressure the company faces. Let's move on to our valuation. To build our valuation models, we'll need to look at EBITDA, EBIT, and net income. Here is what the numbers show for EBIT. From 2009, Nike's EBITDA rose steadily until 2018, when the first signs of slowdown appeared. It remained relatively flat for the next 2 years before the pandemic hit, which caused EBITDA to fall. But then it surged in 2021, reaching its highest level to date. While it has since retracted slightly, it remains significantly higher than pre-pandemic levels. Next, let's examine EBITDA margins. Historically, margins were stable, but decline began in 2018 and hit a bottom in 2020, with 2021 again having the highest recorded margins in recent history, but they also declined since. Over this period, the average margin was 14.9%. Fast forward to the first 2 quarters of 2025, we can see margins have declined even further. This signals that Nike is facing rising operational costs and decreasing efficiency. The same can be observed for EBIT numbers, where the long-term average was 12.7%, with the first 2 quarters again underperforming. Now let's take a look at net income. Net income, the same as EBITDA before, rose steadily from 2009 to 2018, but experienced a sharp drop in 2018 due to the Tax Act, which required Nike to pay one-time provisional charge of approximately $2 billion. Adjusting for this charge, the decline would have been only at 7%. It's also worth noting that 2019's net income was boosted by the lower tax, yet it still didn't reach 2017 levels. Net income took another hit in 2020 due to pandemic, but rebounded significantly in 2021. Since then, it has remained relatively stable over the following 3 years. To get a clearer picture, let's also examine profit margins. Over time, profit margins have generally traded upward, peaking at 13% in 2022. The average profit margin during this period was 10%. In the first 2 quarters of 2025, profit margins were 9.1% in Q1 and 9.4% in Q2. Lastly, we can quickly look at gross margins, which at the moment appear stable, but they are at the lower side. Now, let's use what we have learned to determine the price we should pay for Nike stock. For the first 3 years, we'll rely on analyst estimates. From 2028 onward, we'll assume slightly below average margins for EBITDA, EBIT, and net income. For revenue, we will apply a modest 3% growth rate starting in 2028. Using these assumptions, we can calculate the stock's value using various methods, including enterprise value to EBITDA multiple, enterprise value to revenue multiple, and perpetual growth rate valuation. We'll combine these approaches to arrive at a figure we'll call the fair value. To gain additional insights, we'll compare Nike's average multiples over the last 5 years to industry averages. For Nike, we'll use a company average enterprise value to EBITDA multiple of 24.18 and an enterprise value to revenue multiple of 3.55. For the industry, we'll use averages of 14.21 for enterprise value to EBITDA and 2 for enterprise value to revenue. To be on a safe side, we'll apply a 20% margin of safety to all valuation. We'll use our required rate of return of 9.3%, calculated as a weighted average cost of capital. With all of this in mind, let's see where we stand. Based on company average, we arrive at a valuation of $49.14, while the industry average gives us a valuation of $36.63. These valuations are particularly interesting when we consider Nike's brand value, which we talked about earlier. If we believe Nike's true value should be $49.14, then by stripping away the value of the brand, which is 30%, we are left with $34.40, remarkably close to the $36.63 valuation based on industry averages. This suggests that if we believe Nike's brand will remain strong in the future, we can place more weight on the $49 valuation. We could wrap up here, but I like to dig a bit deeper. By looking at analysts' projections for free cash flow, we can use these figures to compare them to the 2 valuations we just calculated. Additionally, we can also use average free cash flow from the past 5 years and multiply the given number by 20 to estimate the current stock price. And while we are at it, we can also examine cash flow from operation to create another perpetual growth model. This approach, in combining all 3 mentioned valuations, gives us a fair value of $41.55. For our final valuation, we can apply a simple perpetual growth rate based on revenue, factoring both revenue and dividends we would get moving forward. This gives us a valuation of $42.88. Now the question is, what does these numbers tell us? If we average all 4 valuations, we arrive at a price of $42.80. But is this really the true value of Nike? If you believe, like me, that the Nike's brand will remain strong, then in my opinion this price might be too low. Next, let's incorporate the PE ratio to see how these valuations compare to the past. Nike's lowest PE since 2006 was 10.31. With a stock price of $42.80, the current trailing 12 months PE would be at 12.35. However, if we factor in analysts' projections for net income for 2026, then the PE rises to 21.45. Let's keep in mind that analysts expect net income to be at similar levels for the next 3 years, meaning this PE might persist. Before finalizing the price, let's also consider dividends and stock repurchases. Nike currently offers a 2% dividend, with a payout ratio of 39%, which is healthy. However, this payout ratio is expected to rise to 73% in 2026, but then decline to 57% in 2027. While the current dividend shouldn't be affected, its growth potential may be limited with these higher payout ratios. As for buybacks, they have averaged around 1% over the past 5 years. At current lower stock prices, buybacks make more sense and provide additional value for shareholders. So, what what can we take away from all of this? What stock price should we pay? Personally, I believe Nike will turn things around, and considering the 20% margin of safety with a WACC of 9.3%, I would set the target price for Nike stock at $52.50 because of the strong brand history. For this to happen, Nike stock would need to retract an additional 25%, but if the issue persists, this scenario is plausible. However, if Nike delivers strong results and show a clearer path to reclaiming its previous highs, the stock will undoubtedly rebound. With some uncertainties still surrounding the stock, I'm comfortable waiting to see how things unfold in the near future. If the opportunity arises, we could potentially add a great company to our portfolio at a discount. For those of you who made it this far, let's also take a look at what kind of return you can get if you buy the stock now. If you believe $52.50 is a fair value for Nike stock, using our required rate of return of 9%, we can expect a 2.8% return from stock movement alone at the current price of $71.20. With the dividend included, that would bring the total return to 4.8%. So you'd still make a profit if you believe in the numbers presented. Thank you so much for watching, and I'll see you in the next video.